Ladies and gentlemen, we have some urgent breaking news. The US government has officially lost its AAA credit rating. And this couldn't come at a worse time because interest rates have risen at their fastest pace in history. Just paying the interest on their debt is going to become one of the largest payments the US government has to pay. And with the debt clock now reaching almost $33 trillion, it seems like every month they just add on another trillion now. The US government, the US economy is in big trouble. The dollar has been falling. They've been scrambling every single time to try to increase the debt ceiling, but eventually people are going to wake up and know it's a mathematical impossibility that the US government can repay their debt, and all the people that have lent the US government their money, they're going to be calling saying they want it back. So everyone, why and how did this happen? What does this mean for the markets and the economy? Well, that's exactly what I'm going to get into in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, okay, look at this, everyone. Fitch downgrades the US long-term ratings to AA plus from AAA. And again, everyone, look at that debt just pile up tens of thousands of dollars every single second. So Fitch Ratings downgraded the US long-term foreign currency issuer default rating to AA plus from AAA on Tuesday, pointing to expected fiscal deterioration as well as a growing general debt burden. Well, everyone, the chicken is coming home to roost. They've reached the end of the road. They can't keep kicking the can down the road any longer. They've been on this debt binge. They've just printed money every single crisis we've had. They didn't fix any of the fundamental issues. They said, what? Banks failing? What? A few big corporations failing? Here's $5 trillion. That'll fix everything, right? Well, no, like what we talked about yesterday with yellow collapsing, these zombie corporations can no longer exist. And I think what Fitch Ratings knows is they know that we're going to head into a deep recession. The US government is already in massive amounts of debt. And in order to try to get us out of another recession, they're going to use the same mistake again and again, try to print money. But this time they're so indebted, interest costs are so high, they're going to be facing default. Now, I did try to warn you guys about this back in May. So back in May, the agency placed the nation's AAA rating on negative watch, blaming the debt ceiling fight. At the time, lawmakers in Washington butted heads over an agreement that would keep the federal government from running out of money. But President Joe Biden signed the debt ceiling bill on June 2nd, just days away from the ex-date on June 5th. But people, this report just gets crazier, and listen to what they say next. In Fitch's view, there has been a steady deterioration in the standard of governance over the last 20 years. Well, can I get an amen? Of course there has been not a steady decline, there's been a massive decline of governance and the US government. They've become so corrupt, it's all out there for everyone to see what we're seeing with the Biden family, but then, Donald Trump, he gets a speeding ticket and then they want to indict him for that. But we all know what Hunter Biden did, and absolutely nothing's happening. We can see the corruption right in our face. They're no longer trying to hide it. They know they're lying. They know we know they're lying, but they're still lying. And the old saying what Warren Buffett says, don't bet against America. Well, if America keeps on going down this road, I think we should. Including on the fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025, the rating agency said. And they couldn't have said it any better here. The repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management, Fitch said. That's right, they do this all the time. They do this political theater with these last-minute things saying we need to increase the debt limit, otherwise, the whole world's going to implode. Then you'll see the other people saying, no, we can't increase the debt limit. We're going to go broke. We see this political theater go back and forth, but we all know at the end of the day, they're going to increase the limit. But a lot of these rating agencies and a lot of these people that are lending the US government their money, well, they don't find it funny at all, and it's quite frustrating. Imagine if every year when your credit card debt was due, you call up your credit card company and did a little song and dance of if you're going to pay them or not. I don't think the credit card company would be quite happy with that, and, well, US creditors aren't happy with that either. The agency also highlighted the rising general government deficit, which anticipates it will rise to 6.3% of gross domestic product in 2023 from 3.7% in 2022. This is absolutely insane, everyone. The US government deficit is going to nearly double in just 1 year, and with interest rates rising, it's only going to get much worse. In 2022, cuts to non-defense discretionary spending was 15% of total federal spending, as agreed in the Fiscal Responsibility Act, offer only a modest improvement to the medium-term fiscal outlook, they said. But now they give an even bigger warning for the banks, for the credit markets overall, and the economy. The agency also noted that a combination of tighter credit conditions, weakening business investment, and a slowdown in consumption could lead the economy into a mild recession in the fourth quarter of 2023 and first quarter of next year. Now, I completely agree, and guess what? we did just get another report that backs up this claim. Look at this, everyone. Banks say conditions for loans to businesses and consumer will keep getting tougher. This is a credit crunch that I've been trying to warn about all along, everyone. And remember, this economy relies on debt. If there's no more debt being created, well, spending is going to collapse. So the Fed's closely watched senior loan officer opinion survey showed that while credit conditions got more strict, demand declined as well. So we can see here credit markets are being hit from both angles. But listen to this, everyone. Those results are important as economists who expect a recession believe that the most likely source will be from the banking system. That's why I've been trying to warn, get your money out of the bank. Your money is not safe in the bank, and there's going to be more bank failures, which has had to respond to a series of 11 interest rate hikes as well as a monetary crisis in March when the mid-sized institutions failed. But guess what, people? If you thought that was bad, well, they're warning it's about to get much, much worse. So regarding banks, the outlook for the second half of 2023, banks reported expecting to further tighten standards on all loan categories. That's credit cards, car loans, personal loans, home loans, you name it. Banks most frequently cited a less favorable or more uncertain economic outlook and expected deterioration in collateral values and credit quality of loans as reasons for expecting to tighten lending standards further over the remainder of 2023. But don't worry, I'm going to tie this all together in just a moment about how this is all interconnected and some new data we got with the markets and what this means for you and me. On the issue of consumer lending, banks reported having tightened standards for credit card loans and other consumer loans, while a moderate net share reported having done so for auto loans as well. The banks also said they're raising the minimal level for credit scores when giving personal loans and lowering credit limits in the 1.7 trillion consumer loan space. But what else have we been warning about, everyone? We've been warning about the commercial real estate collapse, and the banks have finally woken up to it. So commercial real estate also saw a large share of banking saying they put more restrictions on lending standards along with weaker demand. Fed officials say they're aware of conditions in the banking sector, though they continue to raise interest rates to try to bring down inflation. While they just may have a problem with that because everyone thinks that they've done lifting interest rates, but we have something developing in the markets that could mean we could see another spike of inflation. So this is a chart of crude oil. We can see here it fell to around $68 a barrel, and everyone was cheering, saying, yes, inflation's over. Well, now it's recently rebounded and it's surging from $68 a barrel, and it's now hit $82 a barrel. So if the dollar keeps falling and oil keeps surging, well, guess what? We are still going to see more interest rate hikes. And remember, it's these interest rate hikes that is causing all this pain for the government and all this pain for the banks. So if we do get another rate hike, all these markets are expecting interest rates to be cut early 2024. Well, they may get a rude shock. So okay, I know what you're thinking. Well, what does this mean for you and me in simple terms? Well, I'll show you one last chart before I get into that. Well, look at this, everyone. This is the treasury yields for all the government T-bills and bonds. And we can see when we got this news that the US government lost a AAA rating, well, we can see the 10-year spiked again to over 4%. That's why we saw the market sell off today. They don't like a 10-year over 4%. Also, the 6 month is nearly 5.5%. So this is going to mean interest rates are going to stay higher for much longer than the markets hope. Also, when we go ahead and look at the pre-market for tomorrow, the markets didn't like this as well, all selling off in the red. So everyone, what this simply means is the people, they've already lost faith in the US government, but now institutions are starting to lose faith in the US government as well. There is so much corruption happening, so much irresponsible spending happening, and during the next recession, well, they may print the US dollar into oblivion. And if interest rates don't drop soon, well, guess what? Interest payments are going to be the largest payment for the US government. Deficits, like we saw, are going to double, and this is going to be a huge drag on growth. What I'm doing, people, I've always had a plan. You know what it is. Buy gold and silver to hedge yourself against a falling US dollar. Yes, we did have a spike in the US dollar overnight, but guess what? That's only temporary. I expect it's going to keep on falling. And when that day finally does come, that the US dollar fails, the US government defaults, well, gold and silver will absolutely skyrocket. And people, if you're wanting to learn more how to protect yourself with gold, silver, and Bitcoin against a market melt-up or also a recession, you can click the link for my course below. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.